Here from Share Navigator with a stock market update on April the 11th. So first things first, we're just going to discuss the S&P 500. So just looking at yesterday, so you can see the market finished down 1%. It was down a hell of a lot more at one stage, I think down up to 1.5%. And just interestingly enough, just again, you're always looking in terms of the market taking out previous lows. So the low that was put in about a week ago was taken out yesterday. Now it didn't close below that low, but certainly the low of here. So if you look at there, the low there was 5138. The low of here was 5146. So that's significant that traders just pushed it down below here. So it is a lower low in essence. So this kind of short-term downtrend now is intact. Um, I think actually the market performed well given the news. So what happened yesterday was the inflation data came in hotter than expected. And again, I'm going to marry this in. There's no point in looking at them separately. If you marry it in with the bond yields, look what happened to bond yield yesterday. This is the 10-year yield in the US jumped up to 4.56%, and it's kind of trending higher again. So now analysts are thinking this is actually going to go back to 5%. Okay, that this is probably more likely than 3.5%. So the knock-on impact, and then again, if you look at the dollar, look at the strengthening in the dollar in one go, right down to that previous support level here. Now, this is an area we're watching as well. If it was to push a bit lower and get the RSI, the 5-day RSI here below 30 or 20, this might be an opportunity here to actually go long in the euro dollar, and you could do that through FXE. But we'll talk about that again when that time happens. We're just going to focus in on the S&P 500 at the moment. So just again, just in case you're new and you haven't followed, when bond yields spike the way they have done there, it's usually negative for stocks, and in particular the small caps. So look at the performance of the small caps yesterday. They were down 2.6% versus the broad market index which was only down 1%, let's say. So, the performance was nearly, 1.5 times worse than the overall market. And the reason for that is if you think about it, the small cap companies, they probably rely heavily on financing their operations through debt. And of course, if interest rates are going up, well, then the cost of servicing their debt gets higher. And then when they're kind of refinancing, etc., like that, that becomes a lot higher. So it's another cost to the business. Whereas when you're the likes of Apple, for example, when you have more cash than you know what to do with, it's not actually that big of an issue for a company like that. It's a bigger issue for the smaller caps. Now, again, just why are bond yields bad for equities? Just let me kind of spell it out in a number of ways. Let's think about it from the perspective of the consumer. Mortgage repayments, loan repayments go up, less disposable income to spend. Obviously, the market then starts pricing in maybe profits mightn't be as strong as they had originally thought going forward. So that's one potential outcome. The other one is the way stocks can be priced. So a lot of analysts price stocks based on what they call a discounted cash flow analysis. So they try and guess 5 years forward what the growth rate is going to be, and then they discount it all back using what they call the weighted average cost of capital, which includes interest rates, to today's value, to try and get a value for today. So if you think about it, the higher the interest rate, the higher the discount value, which means that based on that discounted cash flow mechanism, actually the current share price will be lower as interest rates are forecasted share price will be lower because interest rates have gone up and the weighted average cost of capital has gone up. And then the third reason is think about it from the point of view of, let's say, investors who are looking for safety. Maybe they think the market is kind of topped out and they're looking to put their capital into something that's going to generate a guaranteed return. Well, bond yields give you that. So you have the 2 year now back, I think it's at 5%. I'd have to double check that. But think about it, somebody can now put their money on deposit with the US government for 10 years and get 10.6 or 4.6% in annual income from it. And then at the end of the 10 years, they're guaranteed to get their capital back. So that's an attractive investment. If you think about the backdrop of where we've got to, previous to this, you couldn't get 1% on a 10 year. never mind 4.5%. So investors might be tempted to sell out of their stock positions and rotate into bond yield. So I just wanted to give you a quick reminder as to why interest rates are so important to the stock market. So for me, just going back to the S&P 500, then I'm actually surprised they held up so well, to be quite honest with you. I thought it would have sold off a lot more. It doesn't mean that the sell-off isn't coming. Um, but I don't see it as a negative. Again, you've got to marry all of this and weigh it all up with the strength of the US economy. Think about the jobs data. It's still extremely strong. The Fed just upped their GDP forecast. So the US economy is still quite strong. Now, if interest rates kind of start creeping upwards, it might kind of force the hand of consumers to be a little bit more conservative in their spending. So that could change very, very quickly. And don't forget, economic data is severely lagging. It lags in a big way. So by the time you get a kind of a read through that says, you know what, actually the economy isn't doing as well as we thought it was. You could be 2 or 3 months down the line and it's already happening. Um, and that's what the market tends to do. It tends to price that in advance, saying, you know what, the consumer isn't going to keep spending with interest rates being so high. But so far, everything has bucked the trend. The consumer has certainly bucked the trend, and I'm actually quite surprised the market actually was quite strong yesterday. And when I say strong, I mean the S&P was only down 1%, and the news wasn't good. So effectively, the June rate cut has been taken off the table. Now I think the market's only pricing in 2 rate cuts now for the year, and that might dissipate to zero. And some analysts now are all over it. Depending who you listen to, they're basically saying the last mile of inflation is always the hardest to beat, and that the Fed isn't going to cut rates anytime soon. So it depends who you listen to and who you read. Um, so again, keep an eye on the interest rates. I think they're going to be negative for equities, and I think there might be a rotation out here. I think you've got to be careful. So we've been talking about short-term trades with the RSI, etc., like that, but you've got to be very, very selective as well. And there's nothing wrong with just sitting on in cash here at the moment if you wanted. Or again, we'll talk about our natural gas trade. So a bearish sign was we took out this low. A stronger sign was the fact that actually it was only down 1% given the news. And the momentum has certainly dropped again below 50. If this continues down lower, I think we'll see that 50-day get tested first at 5100. And then if that doesn't hold, guys, depending on the momentum, you could get a quick trip down to 4,800. And I think at those levels, I will be a buyer because you're going to have your 5-day RSI below 30 there, and probably your 14-day RSI below 40. So let me just share with you then, whilst we're at it here now, an analysis I've just completed on the 5-day RSI. So this is where, with the S&P 500, you buy it when the 5-day RSI crosses back above 20. So it's crossed down below 20, and now it's crossed back above it. You buy, then you just hold it, you do nothing else, and you sell it when it gets to 70, exactly on the dot. So I want to show you the results of my back test. I went back to 2001, so it's 23 years of back testing. And you can see there's 68 trades in total that would have been placed. Out of the 68 trades, only 5 lost. So that's a win rate of nearly 93%. So this strategy is correct 93% of the time. Okay. Your average amount of time that you would have been in the trade is 4 weeks, not months. These are weeks now, 4.2 weeks. And your average return on investment would have been just over 4%. Okay. So that's statistically significant. There's lots of guys out there putting out all types of stuff about, charts and everything like that, but you can't beat back testing and actually going, does it work? And this strategy actually works. And what I was really impressed with, I want to bring you through some really horrendous times for the market. Look at March 2020. That was COVID. Remember the backside fell out of the market here very quickly. There was a net gain in 2020 for the market here using this strategy here. Okay, coming out of COVID, you would have missed a lot of the upside, so be it. But let's go back to another crash. This is the crash of 2007 and 8. we were net gainers here as well. So this kind of strategy actually maneuvers you well through even even if you're about to go into a crash. Actually, you're kind of out of it quite soon, and the losses tend to be quite limited actually. And then the other one was September. If you think of September the 11th, um, big situation there, obviously. Okay, big sell off after that. That was one big miss here. So out of the kind of the 23 years of data, there was only really one time where you would have been down significantly, and as ever, you're never going to get it right all the time. And don't forget, you're in the S&P 500 here, so you can always just decide to hold and not sell out then when something like that happens, because over time, you know that this it's built to go up over a period of time. So this strategy, I think is a winner, certainly with the S&P 500 index. You would need to back test it in every single stock to make sure it's a winner with every single stock. And that's why, kind of moving on now, I put out two trades earlier. You will see our active trader watch list has increased. So we added CBRE, that's on the US market, so they're in the property market, MTX. So this one here, you can see the RSI is below 20 and it's ready to cross back up. So these guys provide parts for engines for aircraft. Um, they had a big kind of a downturn um, because of this situation here was really down to a callback, and they had to book $1 billion in costs, and they'd intended increasing their dividend payout, but they had to postpone increasing the dividend payout because they basically had to allocate $1 billion in costs for recalls of engines, and that it wasn't necessarily their fault. It was down to a partnership with another company. Um, so that's just a headline of that. You need to know that when you're getting into these stocks now. We haven't decided to buy this just yet, right? Um, but this is another one that came into our watch list, and when we did our homework on it, there's actually quite decent upside. Capgemini there is one. You can see here we've a little note on it. Our target price is 238. The analyst target price is 244, and we bought it in at 207 in and around here just a few minutes ago. So you can see this crossed above the the 5-day RSI, cost above the 20, and it's done it again here. So it came into our equation a little bit later. So we've bought in today anyway, and we've bought into GlaxoSmith as well. So again, you can see this just happened between today and yesterday. So again, these are trades as such. Some will work for us, some won't work for us. But what we have done, remember, I screened this yesterday. There was 8 stocks on it. When I screened it last night, there was over 30 because of the downside in the market. And we've screened all of those stocks, and the ones we've added in is Capgemini, MTX, and CBRE. Um, so Glaxo is one we bought as well. Now I've created another little watch list here, active trades placed. So this is where we're going to keep track of the trades that we've placed. So I'm just going to add in Capgemini to that now. So I'm going to go active trades placed. So it just knows that it's just handy here to keep an eye on it. And I just want to show you what I do. I'm literally going to put in an alert here that says, let me know when this RSI crosses up through 70. That's it. I'll get an alert, and that'll be my cue to sell. Whatever the price is then, if it's better than what he bought it at or whatever, we're getting out then. That's it. That's the strategy in its simplest terms. So we've decided to go ahead as well and track these trades, and that watch list, I'm going to show you where you get it. So you can see now we've added the new active trader watch list. So you can see the watch list here in TradingView by clicking on this link. And if you click on this link here, you can see the trade history. So it's just a spreadsheet, and you can see we've only started with 2 trades. So I'm going to literally keep track of this. Ignore this for now until we get enough data, okay? But literally, this is going to keep tracking this, and every trade that we place, we'll keep an eye on, and we'll keep this going for the rest of 2024 and see how we fare out at the end of the year. So remember, these are quality companies. They have been analyzed, but we're only in them for short-term trades. And remember, keep your asset allocation tight. Don't jump in with 100% of your portfolio. They are individual equities. Okay, so just looking at some of the other ones that are in here. Um, So if you look at the active trader watch list here, you're looking at, Glaxo, we've done AT&T. We'll see what happens when the market opens. Think QSR, think of Burger King. Um, this one here we've added in as well, the Aerospace and Defense ETF. So again, RSI is just about to kind of touch 20 yesterday, and they can get below it. So we keep an eye on that. So remember, all of these are above their 200-day moving average, and they're considered quality. Um, Louis Vuitton, right, had crossed in the past. I'm going to wait for this one. And the reason being, think about what they do. Their exposure to China is enormous. Um, and um, I think that the fact that it's in a downtrend, I mean, I kind of look back at Louis Vuitton, there was a lot of whipshaws here before. So it's not one I'm as comfortable with, just putting that trade on. So that's why I'm kind of holding off here on Louis Vuitton. Um, I used to think of the exchanges. You can see here, that's gone below here. So we're waiting for a cross back up above it. Capgemini I spoke about, and CBRE I spoke about. So that's our active trader watch list. Um, and they've been added into our portfolios as well. Okay. Just finally, just a quick look at we finish up with the equities now in a second. Just the Magnificent Six, I call them now, because I've taken Tesla out of it there. So yesterday, actually, Apple was really the only one. So a quick look at Apple again, and again, it's taken out that previous low. So remember, we said this is your target now at 165, 166 on Apple, and it really needs that to hold. If it doesn't, I think it goes to 150. So we're getting very, very close to that. Microsoft, these are the two biggest market cap, or sorry, weightings in the S&P 500. So Microsoft as well was actually was performed quite well, actually, really, when you consider Nvidia outperformed, Meta outperformed, and Google. So just a piece of news on Google, just from my own experience. I've I don't know if you recall when I did a webinar and I subscribed to their AI tool and I thought it was terrible. I've actually jumped back into it now again, because they've improved it and it's much improved. I have to say it's really good. And as a business owner, small business owner, I don't intend to change that. So I'm just giving you my experiences with Google, because I use Google Workspace to manage a lot of my business dealing, spreadsheets, and all that type of thing. I find it easier to use than Microsoft. And some people will say Microsoft is easier to use than Google. So it's whatever you have in yourself. But I'm just telling you about their AI tool. I've jumped back into it and purchased a license on it, and I actually think it's quite good again. So, just in terms of the potential growth of Google going forward, if you think of all the small businesses out there buying up additional licenses there of Gemini going forward, it could be a lot of upside there. Having said that, we're nearing the top. I wouldn't be a seller at Google now, but I would prefer a pullback before I buy back into it again. Okay, moving on to energy. Again, let's have a quick look at natural gas. So natural gas continues to trade above the 50-day moving average, which is good. Taking a little breather, kind of peaked yesterday. It's come back a small bit here. I think it's going to try and take a two. It'll make an attempt at it. If it gets there, it'll be interesting to see, does it take it out. If it does take it out, guys, I think we fill this gap here up to 233 at a minimum. So two is your next clear target on natural gas. And people, there's no need to ask me anymore. Just my opinion is, as long as natural gas is below two, you buy up the ETFs until you get to your allocation. Okay. And then on crude oil, continuing this kind of rolling rotation upwards, and all the turmoil that's going on in the Middle East, etc., like that. And finally, then into our metals. So a bit of a reprieve here. Obviously, there was a bit of a sell-off then as the dollar strengthened in a big way yesterday. But still, this is seriously impressive. And copper in particular, they're linking a lot of this to the development of EVs, etc., like that, and the shortage of copper. Now, we had talked about a shortage of copper coming, but it was on the China rebound story. That's where I was going with it anyway. But obviously the market is pricing that in now. So I think we're going to have to reevaluate all of that. I wouldn't be buying into it now. I'd be a seller into this but maybe we're not going to see down here again. We're just going to have to wait and see how this pans out. Okay, so this is Stephen with a market update. The S&P 500, let's see if there's follow through today. So far, the futures are not really showing much, but those bond yields are not good. The strength of the dollar is not good for equities, so I would be cautious. Okay, thanks for tuning in, and thanks and bye for now.